Savings and credit cooperatives first appeared in Germany in the 1870s. The idea moved to North America in 1900 with European immigration. Canada, the United States, Australia, and Ireland had the most established movements. In many regions of these countries, SACCOs are much larger than the commercial banks. Globally, there are almost 100 million individual members in 60+ countries around the world, and SACCOs are a member of World Council of Credit Unions. Through this relationship, SACCOs enjoys a reciprocal relationship with member countries throughout the world. SACCOs was formed in 1993. It evolved from the Cape Credit Union League, SACCOs, which was formed in 1981. At this time, various Catholic Church parishes decided to form credit unions, and SACCOs was formed to help them to coordinate their activities and standardize their operations. At this time, though, the credit unions were formed as social organizations and did not operate their cooperatives as businesses. This brought about a whole lot of problems. Because the credit unions did not pay good interest on savings but gave out loans very cheaply, members were not interested in saving with the SACCOs, only getting loans from the SACCOs. Without savings and shares, the SACCOs were unable to grow. However, because members were enjoying the cheap loans, they did not want to change the way they operated. Without growth, it was inevitable the SACCOs would stagnate. A second problem that existed in those days was people were scared to take up leadership positions, as there existed a state of emergency in the country during this period. This resulted in the ministers of the parishes taking a leadership position in the SACCOs. If the minister was transferred to another parish, it would depend whether the incoming minister had knowledge about a SACCO and whether he was interested in continuing its activities. However, the idea of a SACCO grew in impoverished communities as an alternative to other savings schemes, where you could get cheap loans. In 1987, the SACCOs extended its activities outside of the Western Cape region and formed itself into the South African Credit Union League. The problem of non-viable SACCOs still existed, and in 1991, when the World Council of Credit Unions did an assessment of the viability of the movement in South Africa, they found that only 3 of the existing 47 SACCOs were viable. As a result of much discussion within the movement, it decided to change its entire orientation toward a business orientation. The viable cooperatives argued that making a surplus and developing strong SACCOs was in members' interests in the longer term, rather than short-term gain of cheap loans only. Thus in 1993 the Savings and Credit Cooperative League of South Africa, SACCOs, was born. A SACCO, Savings and Credit Cooperative Organization, is a member-based financial service institution. It is a self-help organization by way of which groups of people pool in their savings and provide loans to these very members. Savings groups are an especially important alternative for the vast number of women who are unlikely to be served by financial institutions due to the lack of a savings culture and needed documents that banks ask for. SACCOs help people to cultivate a savings habit and investment culture and allow them to borrow a loan as per their needs. The aggregated savings in a SACCO group are used to give out loans to its members. These loans may be working capital loans, for any purposes like weddings, children's education, house renovation, health, or any personal or emergency need. How does a traditional SACCO work? SACCO groups are structured to prevent just one person from having access to group funds. These groups store money in a box protected by 3 locks. The group's treasurer keeps the box, and there are 3 additional key holders. These 4 individuals only come together with the box and keys during group meetings, and group funds can only be accessed during those times. Difference between a SACCO and a bank. Which is a better loan? Banks are for-profit making financial institutions owned by people or private investors and governed by a board of directors chosen by the shareholders. SACCOs are non-profit financial cooperatives owned by their members and governed by a board of directors elected by, and from among, those members. The real interest rate of a SACCO loan in Africa is even lower than 12%, compared to bank loans which can easily be double the rate. How has technology given a traditional SACCO a digital touch? With all the successes and benefits of savings groups and mobile phone technology, Combining the two creates the potential to improve each. The mobile product has been designed to replicate the traditional SACCO system. Keeping the traditional concept as is, digital technology touch is given to a SACCO functioning, which can be accessed from low or no internet zones and also from a low-end mobile handset to help the rural population. The group wallet involves one individual who holds the group SIM, and 3 additional mobile users and PIN holders who are like the key holders. These 3 people will be notified when the SIM keeper initiates a cash-in or cash-out transaction. The SIM keeper can request a transaction, but all 3 must approve it before cash can be withdrawn. These individuals will receive a text message with an identification number indicating they need to approve the transaction before any money is moved. The rest of the group members are treated as notification recipients who receive the notification on their mobile when an activity is done in the group. The service will incorporate the following tools: group accounts, a group wallet to support the safe storage of group funds as mobile money. Record management, many statement regular mobile reports can be generated to summarize transactions during that period. Mobile banking, the group savings product can be linked to bank accounts at financial institutions to allow access to interest-bearing savings and credit. Credit will be dependent on saving history, and installments can be paid from the group wallet. Objectives of a SACCO include but are not limited to: organize, promote the welfare and economic interests of its members. Provide a source of fair loans and reasonable rates of interest. Promote personal growth through the introduction of new products and services that will promote the economic base of its members. Ensures progress of its members and society through continuous education programs, on proper use of credit, reduction of poverty, human dignity, and cooperation. Affiliation to the relevant National Cooperative Credit Union and the Apex Society. A SACCO is not individually owned by a group of people, but by all members who join the SACCO. A pyramid scheme or some form of a merry-go-round. A bank that will turn away people as bad credit risks. A subsidiary, franchise, or branch of a company or financial services loan scheme. A loan shark with intentions of exploiting people. A profit-making organization. Profit is not the motivating factor. Service to membership is the drive and motive of the SACCO. The difference between a commercial bank and a SACCO. At first glance, the difference between a bank and a credit union/SACCO may seem insignificant, but there are some distinct differences between them in terms of business purpose, ownership, regulation, operations, and governance. Banks' emphasis is on business and consumer accounts, while SACCOs/credit unions' emphasis is on member deposit and loan services. Banks are for-profit-making financial institutions owned by people or private investors and governed by a board of directors chosen by the shareholders. SACCOs are non-profit financial cooperatives owned by their members and governed by a board of directors elected by, and from among, those members. Usually there is a common bond among the members of a SACCO, such as belonging to the same organization or living in the same geographical area. It is not the case with bank owners. In a SACCO ownership, every member is an equal owner, while banks' ownership depends on the number of shares a shareholder owns. SACCO boards of directors are elected by members. They are volunteers, and are not paid salaries but given a minimal sitting allowance, if and when the SACCO can afford to do so. Banks' boards of directors are elected by the shareholders. They are paid and legally bound to make decisions that benefit the shareholders. SACCO/credit union elections are held annually, with each member getting a single vote regardless of their amount of savings. Bank owners' number of votes depends on the shares holdings. In SACCOs, no single member is allowed to own more than 25% of the total shares, while in a bank there is no such restrictions, one may own as many shares as they wish. SACCOs always offer competitive fees and lower interest rates on loans to their members than banks do to their customers, because SACCOs are not driven to make profits. In a SACCO, net profits that are earned are shared between all members in form of dividends, based on a member's shareholding percentage, while in a bank, only the shareholders receive a share of the profits. A savings and credit cooperative organization, SACCO, is a member-owned financial cooperative where individuals pool their savings to provide loans and other financial services to each other. SACCOs operate on a not-for-profit basis, meaning their primary goal is to benefit members, not external shareholders. In many African markets, SACCOs are key drivers of financial inclusion, serving communities where traditional banks have limited reach. While both provide savings, loans, and financial services, the ownership and mission set them apart. A bank is owned by shareholders and focuses on profit, while a SACCO is owned by its members and focuses on member benefits. SACCOs often have simpler loan qualification processes, stronger local trust, and closer community ties. Banks and SACCOs can complement each other. SACCOs bring reach and relationships, while banks bring infrastructure and advanced products. SACCO members are highly engaged and loyal because they're both customers and part owners. This means they are more likely to use services regularly and trust the institution. For financial partners, this loyalty translates into stable transaction volumes, cross-selling opportunities, and a lower cost of customer acquisition in markets that are typically expensive to penetrate. Traditional SACCOs rely on manual processes that limit speed, reach, and transparency. Digitization enables 24/7 service access, real-time reporting, automated loan approvals, mobile payments, and compliance readiness. For partners, a digitized SACCO means faster transactions, better data for decision-making, and easier integration into wider payment ecosystems. Thank you for watching this video.